Hello and welcome to the latest market update with me, Andrew Dawkins, and
myself, Daniel Baverlock. How was your June, Andrew?
June was good. A little bit wet
and cold.
Wet and cold. And of course now we've got the start of the Scottish school holidays and Wimbledon, so likely to get
worse.
Yes. Anyway, halfway through the year already.
We are. That's right. Yeah. So how have the markets performed?
Well, I thought we'd perhaps just have a look at the last 6 months and see what we were hoping for at the beginning of the year. A lot of things have come good, as we expected they would. One or two little surprises that central banks, by and large, haven't started to reduce interest rates as quickly as we might like. And numbers are looking reasonably good on the inflation front. That's reducing substantially because of the huge energy price increase that we got just after the Russian invasion of Ukraine. So that started to come out of the system at the moment. So a lot of things that we were hoping for have come on, but the cut in interest rates is still yet to materialise to any significant extent. By and large, though, a lot of the funds that we use have shown really good performance, and we're seeing good growth rates. Some of the specialist funds still badly affected by the effects of COVID-19, but generally I think we've got to say that the last 6 months has been positive.
So the first 6 months of the year have been good, and how was June in relation to the last 6 months?
Yeah, June was, I think we'd say, a quiet, fairly flat month across many of the asset classes we look after. And a bit of profit taking early on, a little bit of unease in the markets given what's happening still in the Middle East. The best in class for June was US equities, and closely followed by European equities, and UK equities on the whole were probably underperforming. So last month we saw UK equities doing really, really well. This month it's a must do better.
You mentioned Europe there, mainland Europe. How did they perform last month?
Yeah, so it was a reasonably flat month for Europe, but inflation continues to fall, so it's back at the moment to around about 2.5% across the Eurozone. So that's down 0.1% against the figures from May. And at last we started to see the common sense returning, with the European Central Bank reducing interest rates on its lending by 0.25 of 1%. They were the only major bank to do that, with the Bank of England and the Federal Reserve continuing to adopt the high interest rate for longer policy. We saw as well that France, President Macron calling a snap election towards the National Assembly, which, when it was called, sent shockwaves through the French market because of the fear of right-wing victories. And the first runoff for places at the weekend did indeed give a bit of a run to the right-wing parties, but not quite as much as polls had been predicting. So markets recovered on the back of that, and we're still halfway through the month with that. Airbus shares slumped as the manufacturer, who's awash with orders, reported difficulty in getting parts and fulfilling orders. So the share price took a bit of a thumping on that. The German economy continues to start to get a little bit better. Still not doing great, but it's getting there. Things in Holland and Belgium, around that area, they're producing well. Some good results from brewers, exporters. ASML, which is a large manufacturer of machinery which makes microchips, delivered really good results. That's held in many of the portfolios that we look after. And all in all, actually, Europe's not looking too bad a place at all to be invested, especially long term.
We'll say goodbye to mainland Europe and say, hey, y'all, to the US of A.
Oh. The USA provide good growth for us last month, and by last month I mean June. The new jobs market, though, shrank, and amount of unemployed actually increased, meaning that the labour market now is starting to loosen a wee bit, which is perhaps a sign that the economic policy is starting to work. As we've said before, it's rather weird that the market gets excited when the number of people without jobs actually increases. You would think it'd be the other way around, but that's the weird way we've got of the world at the moment. The economy is growing at 1.7%, but the rate of growth is falling. It was 2.2%. The latest manufacturing reading is 48.5. Now, that means that the stuff that they produce, any reading below 50 means that order numbers are falling, so going into contraction. Inflation is continuing to ease, but it's still sticky, as they say. And with that in mind, many people now believe it's time that the Fed should get off the fence and start reducing interest rates, which we've been saying for ages and ages. Not that they'll take any note of what we say. And then we had the first televised presidential debate. My word. I think really this sort of adds more strength to the fact that perhaps Donald Trump could have a second term in office, which for investors could be a little bit problematic given his protectionist stance, which could ultimately lead to inflation remaining higher for longer, given that America does import a great deal from overseas, and if you start putting tariffs on things like Chinese goods, or even more tariffs, there are already tariffs on a lot of the goods there, then it just increases prices for US consumers, and probably the last thing they want to see is prices going up again. But hey-ho. Interesting one, NVIDIA, we mentioned it on the update for May, and that saw its share price increase to make it the world's most valuable company. But then this month, June, we saw it suffered the biggest fall of any American stock in 3 days, and it lost $430 billion of value. So what a difference just a few days make. Incredible.
It's all happening in the USA. It's also happening here in the UK, especially with the election. But how did we all fare in the UK here last month?
So for the UK, it was a fairly quiet month after big gains in May. So June saw a bit of profit taking, I think, really. So a fairly flat month. But inflation finally fell to this magical, mythical 2% target, but still not enough to make the Bank of England reduce interest rates, so they're held again. The interesting thing is that the Office for National Statistics reported the UK economy grew faster than expected, up 0.7% in the first quarter of the year. Now that means the UK was the fastest growing economy of the G7. Now, your question, Dan. Which nations make up the G7?
USA? Germany?
Yeah.
France?
Yeah.
UK?
Yeah.
The European contingent?
You go over to America, a bit up from USA.
Canada?
Yeah, and then go over to the Far East.
There's Australia there, though. That's the most important thing.
Right above Australia, keep going up, 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 up.
Right above it.
Group of islands.
China. No, group of islands.
Group of islands starts with a J.
Japan.
Japan. Well done.
Not near Australia, I guess.
Well, no, I said keep going up, 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 up,
Oh,
up.
way up.
Keep going way up. It's still up, isn't it?
It's true, it's true.
Now, that's only 6. So, now, the 7th is actually not a single country, but it's the European Union.
Oh.
So there you are. That's not the interesting fact of the month, though, which we'll come to in a minute. No, we'll come to it in a minute. So back to the UK, earnings in real terms increase and continue to increase. That means that people are seeing generally an increase in pay packets above the rate of inflation, which is good. Household savings increased as well. People's disposable income increased. And gross domestic product, the amount we produce, increased in real terms. In other words, when we divide it by the number of people that live in the United Kingdom. Unemployment increased, not too much, but it went up. Retail sales fell in June, probably due to the very poor weather, which does have a major impact on the stock market, believe it or not, with fewer shoppers about.
That's the big three out of the way. So what about the rest of the world?
The rest of the world. Well, we will go to that country you're stumbling with, beginning with a J, Japan.
Jamaica. Oh.
Oh dear, yes. And the Japanese yen. Well, those people that have got an eagle ear and an eye will remember a little while ago we were saying that the yen reached a low of 150 to the US dollar. Well, it got slightly worse, now to 160 yen to the dollar. For those companies that export from Japan, that's generally good news because, your pound goes further against the yen, so you can buy more from Japan, which is good. For consumers, not so good though, as they need to pay more for stuff imported into the country. So a bit of a mixed message there, but it really shows the strength of the dollar and what the Federal Reserve, the US Central Bank, can do in that. Obviously, interest rates between 5.25 and 5.5 over in the States, but in Japan you've got near 0% interest rate. So therefore, if you're getting more dollars and more interest in America, you're going to go there rather than Japan. The good thing about Japan is that a lot of the population of Japan are very loyal to the government and the country, and they will buy significant amounts of Japanese debt, which keeps them afloat, but they still have the worst debt ratio of any nation that's actually currently around. So it's sort of an interesting period. India is a success story for this year. They, according to data released by FE Fund Info, the stocks in Indian funds rose 8% in June, making it the best market and the best asset class in terms of equities, etc. In the world. Good old India. Well done. We won't mention anything about the dreadful performance of England against India in the T20 World Cup.
Covered all the areas, so what have we got now, Andrew?
Well, we have the interesting fact of the month. Interesting fact of the month.
Oh.
According to the Centre for Crisis, yes, there is such a place, the UK housing deficit has reached 4.3 million homes.
What?
Quite a number, isn't it? I was just looking back, and in 1951, I remember it well, Winston Churchill, Prime Minister, tasked Harold Macmillan to build houses. How many do you think he managed to build in a year? 300,000.
Oh.
So 300,000 homes were built in 1951. So it shows it can be done. He must have been very, very tired at the end of the year, though. Yes.
Finally, as we do every month, let's look at the portfolios and their performance across the last month, 6 months, 5 years and 8 years. And we'll start with the defensive portfolio.
This month up 0.2 of 1%, 6 months up 3%, 5 years up 17%, and 8 years up 50%.
The cautious portfolio.
This month down 0.01 of a percent, over 6 months up 4%, over 5 years 26% growth, and 8 years 74% performance.
Balanced portfolio.
This month, no change. Over the last 6 months, up 5%. For 5 years, we're up 37%, and over 8 years, 100%.
Capital growth portfolio.
This month, down 0.2 of 1%. Over the last 6 months, up 6%. Over the 5 year period, 45% growth, and 8 years, 124%.
Finally, the aggressive portfolio.
This month, down 0.2 of 1%, over 6 months up 7%, over 5 years up 53%, and 8 years up 148%. Now, one interesting fact I've got here is that over 6 months, each of the 5 portfolios has increased in value 1 percentage more than the last. So, for example, defensive up 3, cautious up 4, balanced up 5, capital growth up 6, and aggressive up 7.